To be a good investor, we always have to ask the question, where is the stock market headed? Other than late last week, the stock market has operated on the greater fool theory. This may continue if a popular valuation measure continues to move higher, and that may kick off another stock market bubble similar to late 1920s and 1990s. So, let's take a look. Barry Bannister, who's the head of institutional equity strategy at Stifel, and who also called the market's rally off the March lows, noted that the cyclically adjusted price to earnings, or the CAPE ratio, was near or at levels last seen in the final 2 years of rallies in the 1920s and the 1990s. And the CAPE ratio measures the price of the S&P 500 divided by average corporate earnings over the previous decade. And by taking such a long view of 10 years, the measure is intended to smooth out cyclical variations and give a better view of where valuations stand today versus history. And it's much like our charts when we take a look at the longer terms, such as the weekly or the monthly charts. In fact, for me, the longer term view is much better as it captures more context. And as you can see here in the upper portion of the chart, the CAPE ratio, it's bumping up against the long-term trend line, at least as defined by the chart. So if the CAPE does break the trend line and on the upside into the red, we could be moving into the historical bubble territory. And in that case, the market becomes an even greater game of the greater fool. And for those of you who don't know the greater fool theory, it's used to describe loftier, bubbly markets in which investors buy stock regardless of the underlying fundamentals. The investor, or shall we say, the gambler, is confident they can sell the stock later on at a higher price to an even greater fool who also hasn't studied the fundamentals. And as for this chart, I suggest that everyone go ahead and pause the video and take the information in on both the upper and lower portions because there's some good stuff here. And this chart here represents the NASDAQ index relative to the S&P 500 index. And what it represents is that with the Federal Reserve moving to hold down bond yields, the equity risk premium, or in other words, the added return over risk-free treasuries demanded by investors to hold riskier equities or assets, it's under pressure. Past peaks by the S&P 500 index over the past 100 years have coincided with bottoms in the equity risk premium. These stock market rallies have been driven as investors are willing to pay out more for each dollar of earnings. In other words, an expanding PE multiple. So, if the Fed can continue to hold down the 10-year real yields, then maybe the S&P 500 would soar. But remember, after the peak comes the pain. This is in part why we always keep an eye out for the 10-year yields. I haven't had much to say about interest rates lately, but I'm always checking. And as you can see in the red box, the NASDAQ 100 suffered a painful unwind in the 10 years after the 2000 peak, the dot-com bubble, while the PE ratio of the NASDAQ fell more than earnings per share grew. So personally, I'm more concerned about the stock market collapse than I am about the following 10-year period, as we can always find great opportunities during that time frame. I'm more concerned with Buffett's rule number one, which is don't lose money. And as you know, rule number two is don't forget rule number one. And lastly, this chart shows what I'm researching right now. And the chart shows the secular bull and bear markets from 1920 to 2020. We've been in a bull market since 2009, but that's going to change sooner than we all want. So stay tuned to this channel as we will likely know before most when the market is changing. And for today, that's ChewDog Charts. Thank you.